Of financial markets. Financial markets plays an important role in the allocation of scarce resources in an economy by performing the following four important functions. First one is mobilization of savings and channeling them into the most productive uses. A financial market facilitates the transfer of savings from savers to investors. It gives savers the choice of different investment and thus helps to channelize surplus funds into the most productive use. Facilitating price discovery. You all know that the forces of demand and supply help to establish a price for a commodity or service in the market, in the financial market. The households are suppliers of funds and business firms represent the demand. The interaction between them helps to establish a price for the financial asset which is being traded in that particular market. Providing liquidity to financial assets. Financial markets facilitates easy purchase and sale of financial assets. In doing so, they provide liquidity to financial assets so that they can be easily converted into cash whenever required. Holders of assets can readily sell their financial assets through the mechanisms of the financial market, reducing the cost of transaction. Financial markets provide valuable information about securities being traded in the market. It helps to save time, effort, and money that both buyers and sellers of financial assets would have to otherwise spend to try and find each other. The financial market is thus a common platform where the buyers and sellers can meet for fulfillment of their individual needs. Financial markets are classified on the basis of the maturity of financial instrument traded in them. Instruments with a maturity of less than 1 year are traded in the money market. Instruments with a longer maturity are traded in the capital market. The money market is a market for short-term funds which deals in monetary assets whose period of maturity is up to 1 year. These assets are close substitutes for money. It is a market where low risk, unsecured and short-term debt instruments that are highly liquid are issued and actively traded every day. It has no physical location but is an activity conducted over the telephone and through the internet. It enables the raising of short-term funds for meeting the temporary shortages of cash and obligations and the temporary deployment of excess funds for earning returns. The major participants in the market are the Reserve Bank of India, commercial banks, non-banking finance companies, state governments, large corporate houses and mutual funds. Money market instruments. First one, treasury bill. A treasury bill is basically an instrument of short-term borrowing by the government of India maturing in less than 1 year. They are also known as zero coupon bonds issued by the Reserve Bank of India on behalf of the central government to meet its short-term requirement of funds. Treasury bills are issued in the form of promissory note. They are highly liquid and have assured yield and negligible risk of default. They are issued at a price which is lower than their face value and repaid at a par. The difference between the price at which the treasury bills are issued and their redemption value is the interest receivable on them and is called discount. Treasury bills are available for a minimum amount of rupees 25,000 and in multiples thereof. For example, suppose an investor purchases a 91 days treasury bill with the face value of 1 lakh for 96,000 rupees. By holding the bill until the maturity date, the investor receives rupees 1 lakh. The difference of rupees 4,000 between the proceeds received at maturity and the amount paid to purchase the bill represent the interest received by him. Commercial paper. A commercial paper is a short-term unsecured promissory note negotiable and transferable by endorsement and delivery with a fixed maturity period. It is issued by a large creditworthy companies to raise short-term funds at lower rates of interest than market rates. It usually has a maturity period of 15 days to 1 year.